And we're live.
Good afternoon and welcome to another Ask Me Anything. I'm Drew Clark, editor and publisher of Broadband Breakfast. Very excited to welcome Brian Vo to the Broadband.Money community, where we talk about anything that you want to ask Brian Vo. Brian is the Chief Investment Officer at Connect Humanity, which in itself is a very interesting organization. We're going to drill into what Connect Humanity does, what Brian does with Connect Humanity, and all manner of aspects of financing when we're talking about broadband projects. Brian, welcome, and thank you so much for being with us.
Thank you, Drew.
So, Brian, we've had folks on this program, from Vince Cerf to Jim Baller, from business folks like the CEOs of Starry and LTD Broadband. So we're really covering the range of folks with some particular angle as a provider or policymaker or attorney, or in your case, a finance expert. Talk a little bit for us about Connect Humanity. What is Connect Humanity? What led it to get formed? And what's your role there at Connect Humanity?
Yeah, absolutely. So Connect Humanity is a impact fund advancing digital equity. And I think what makes up our North Star is we really try to frame that concept of digital equity really holistically, right? That is our North Star. So when we think about what would it take to get folks, and underserved folks, connected, but also connected meaningfully, what does that mean? And that's where we've outlined 5 major parts of our approach. So that's the infrastructure part of it, right? You do need that connection. We put devices in there as well, but it doesn't stop there, right? You need affordability. You need locally relevant content. You need digital skills, digital literacy to be able to meaningfully use that infrastructure. And you need a supportive, enabling regulatory, right? The policies that help set that up. And so because we're able to frame our North Star along those different 5 dimensions, it really helps us think about, okay, if that's what it takes to achieve digital equity, each of these components, what is needed in the environment to help move things towards that. And that's where we've really focused on building out a spectrum of capital to enable service providers, operators, communities, all the folks who are doing the work on the ground, to provide them the capital tools that they need to push that forward. And so when we think about that spectrum of capital, it's on one end philanthropic sources, all the way through to the other end, which is investment funds. And so really a lot of our work is thinking about what's the most relevant type of capital to bring into two different situations to make the thing work. So internally, Chief Investment Officer, I lead more of that investment side of it. A lot of my peers work on the philanthropic side of it, and we work hand in hand to figure out, for this community, given their context and what they're trying to do and what their needs are, what is that best set of capital that we can provide for them.
Let's take that in two topics. Let's drill in 2 things. So one is the holistic stack of 5 that I'm going to repeat those in just a second. Let's do that first. And then the second is like who you are. You're a nonprofit, obviously, but like how that applies to the financing. So let's go back to the stack for a moment. My notation was infrastructure, affordability. Okay, so infrastructure meaning, okay, the towers, the fiber, the things in the ground that get broadband there. That's infrastructure. Affordability, okay, yeah, but you don't want broadband that's $120 a month, right? I mean, it needs to be more affordable to really make a difference. Digital skills, okay, this is like making sure people who aren't as familiar know what to do when they have a broadband connection. Let's talk a little bit about that too. And content, okay, and I'd love to get a little more on like does Connect Humanity do content? Do you work with other providers? And then policy, and obviously policy is undergirding so much of this, right? It's policy that's driving the Infrastructure Investment and Jobs Act to do infrastructure investment focused around affordability, focused around making sure that digital equity is enabled. So just those 5 things, how do you view the interrelationship of those: infrastructure, affordability, digital skills, content, and policy, Brian?
Yeah, so because that's our North Star, that's our framework for looking at every problem. It just depends on where in the journey, a community is at when we start talking with them. If the community says, we don't have the infrastructure, then we need to start there. As they're planning for that infrastructure, we're going to ask questions around, well, what are the gaps around digital literacy? And as part of your build, what type of digital literacy program might you need to go with it, right? Because just because you build it doesn't mean they will come. Well, those two in and of themselves, you may still not get meaningful connectivity if it's just priced too high, especially for median household income. And so that's where the question then becomes, okay, well, the next barrier could be affordability. How are you incorporating that into the build? Are you offering things like ACP? Do you have a low cost type of package? Okay, that's there. But what other barriers could there be? On the content side of it, if folks, and this is tied a little bit to the literacy side of it, but if folks don't know what they can access or do online, if they don't have access to that content or know that content even is out there, that just makes it less likely they're going to materially, meaningfully engage. And so what does locally relevant content mean in practice? I think in a lot of our conversations, it's bringing in different types of service providers, whether that's healthcare, right? Content could be telehealth and being able to push that as a service into rural populations, especially. Could that be financial literacy and financial inclusion, being able to get banking services in for folks? It could also be a lot of public services too, right? Instead of waiting 3-5 hours at the DMV, being able to process a lot of that online, right? And so I think that the content part goes really closely with that literacy part of it, of knowing what can you really do by being connected. And then of course, policy, understanding the context in which we're trying to not only do the build, but also, kind of the wraparound services, if you will.
So Brian, a lot of people who are not experts in finance, and I certainly put myself in that category, may have in their brains a paradigm where, okay, there's one source of financing, public financing, government, right? And we can apply for a government grant or maybe get money from a universal service related program, right? And so that there's a paradigm of the government is going to give money or grant money, and there are obviously conditions on it and match and so forth. That's one paradigm, right? And the other paradigm of, then there's banks, there's the private sector, private financing, and they'll lend, and they'll either do debt lending for a loan or equity, taking a stake in the venture. Why is that framework of public and private financing overly simplistic, or like what's wrong with that? What is that missing from the financial piece that you at Connect Humanity would like to underscore?
Yeah, that's a really good question. I think that is, we know the problem of digital exclusion is big, right? And to date, the sources of capital that we've tried to throw against that problem have only moved us so far to where we are today. And so when we think about, how can we go about solving the rest of the problem, connecting the rest of the world, the rest of Americans that aren't on, we know we're going to need new and/or different types of tools. And so I think just thinking about those two sources of capital, public grants especially, and private capital, or at least commercially oriented capital, is too limiting, is too constraining. And those are well designed especially private capital markets, are well designed for the business models that we've seen deployed to date to get people connected. When we think about and underserved folks, low-income communities, rural communities, redlined communities, those business models, aren't serving them. And so not only do we need to think about different types of business models and how we think about, really associating what is the real risk return here, but also for those risk return profiles, they're going to need different types of capital. And that's why we were quite intentional in thinking about deploying blended finance against this.
Define that term, blended financing. What does that mean?
Blended finance, the general concept would be mixing and matching different sources of capital. And so a really simple example would be student loans, right? Or paying for college or university. If you enroll, you're probably putting a little bit of cash in yourself. You call that your own equity. You might get, a zero interest loan from mom and dad. You might qualify for federally subsidized loans. That could be concessionary capital. You might need to go to private markets for, kind of fully baked interest rates types of loans. And you need to cobble all that together to pay for tuition and room and board. That is a version of blended finance, right? You're mixing and matching all these different costs of capital and sources of capital to be able to pay for college. Similar thing on the infrastructure side, grants, especially public grants, even though, we're seeing a huge commitment from governments to put money down on this. We know it's still not going to be able to pay for 100% of everything, right? So where can we pull in private markets? Well, we know private markets are going to have certain rates of return that they may not look at certain communities. Do we need to pull in philanthropy, right? And think about grants from private foundations. But we know that capital is also very limited, highly risk-seeking, but very scarce, right? And so when we think about a build, what is the most optimal version of taking X percent of public grant, Y percent of private, Z percent of philanthropy to make the network economics work? So that kind of in a nutshell is blended finance.
No, that's great. And that's a great pathway in just a moment into the nonprofit mission and nature and the different types of financing that Connect Humanity is involved in. But first, obviously, we as a community are very concerned about the Infrastructure Investment and Jobs Act. We're very focused on that, as well as other broadband funds. But IIJA is kind of the big kahuna, right? And so I just want to ask Brian, the notice of funding opportunity came out 7 days ago. They were required by law to come out with them, this Monday, and they beat the clock a few days. Have you had a chance to look at it? What's your initial read on those rules that they've put in place, particularly the match requirement, and what that will mean for the mission that you have of making sure there's digital equity in terms of broadband deployment that's affordable, that's used, et cetera, et cetera?
Yeah, really good question. It's still digging through the technicals, as I'm sure a lot of other folks are. I think my big takeaway from a financing perspective was, I would say, both a validation, knowing that it isn't going to be enough. It is a huge commitment, but it's still not going to be enough. And I think everybody knew that going in. And to an extent, nor should it be everything, right? I think that allows for a lot of other opportunities, creative opportunities at the local community level. So I think that was a big chunk. I think the other one was very much opportunity, right? And so I think seeing the opportunity for community voices, especially, to be centered at not only the network design, but what else might that community need to make those connections and make that network really meaningful for them. whether it's designing around certain community institutions, anchor institutions, or other services and capacity building that might need to go around it. So I think that it was very both validating and I think creates a good amount of opportunity, and really still points us back to our North Star of that holistic approach, because it really showed a lot of those. It recognized, I think, that it's more than just infrastructure that's going to be needed.
Absolutely, absolutely is clear. In fact, I had a chance to interview Alan Davidson, the head of National Telecommunications and Information Administration, last month at our Broadband Breakfast for Lunch club. I will have the opportunity to interview Alan again next Tuesday at Mountain Connect. And if you haven't registered, do so. It's in Keystone, Colorado, and all of those who are watching this will be able to watch that as well here on the Broadband.Money platform. But one of the things that Alan totally emphasized when he was with us last month was that we're not going to be happy until we have affordable high-speed internet. He really emphasized that affordability component, and I think that's a key for the administration. So I'd love to talk more about affordability, and if you've got any things to say on that'd be great. But I want to make sure I'm understanding the match component, right? So how do you all at a nonprofit organization that is involved in funding broadband digital equity, how do you look at those match numbers? What do you see when you read the NOFO and what it says about a 25% match minimum?
Yeah, well, let me step back for a second and say, what are the major kind of verticals of funding we provide?
Please do. That's great. Thanks for bringing us back to that.
The match part, I think, impacts different parts of those verticals differently. And so when we say we're deploying a spectrum of capital to try to advance digital equity holistically, what that means in practice is on the philanthropic side, we're often engaging communities and trying to meet them where they're at in their journey to digital equity. Most often that means communities at the beginning of that journey saying, we have a problem, but we have the political will, the stakeholders aligned to solve this. We just don't know what the network's going to look like or even how to go about it. And so for those communities, we'll provide a planning grant of sorts, which gives them the time, space, resources to work with experts, consultants who can really answer three questions for them. The first is around the network technical design. What are different options for an optimal network design? Is it fiber, wireless, hybrid? What could different owner operator models look like? What are the different cost benefits to each of these different modalities, if you will? The second one is around community engagement. And so to what extent can we include community voice in that planning process? And it's not just where passings are going to go, but it's also that, the skills assessment, what are literacy gaps, and what are the best community anchors, whether organizations or places, to be able to provide that content. So that's where and hopefully what you heard earlier in the way I was talking about community engagement, from I think the equity perspective, a lot of that is making sure we're solving the human side of connectivity, right? Because it's not just lines and wires. At the same time, from the investment perspective, to me, those are the real underlying drivers of take rate, right? So when I'm thinking about, the risk return profile of an investment, that questions like that and conversations at that level allow me to go a lot deeper than kind of a classic demand survey of like, if we were to offer you, X speed for Y dollars, would you buy it, right? Being able to unpack that down to that level of digital equity, like the underlying drivers and barriers to access, that allows us to really understand the nature of, I would say, the business risk as well. The third component is the business model then, which is what are these network economics? And I think the way we think about it is a network economic profile isn't a go, no go in terms of investment, right? I think especially if one appears, on the margins of sustainability. For us, that's a signal of what other sources of capital do we need to bring in to make it sustainable, to make this financing work. And so if it is looking to be unprofitable for the first couple of years, do we need to provide an extended no interest period, or do we need to bring in more grants to subsidize some of the infrastructure costs? So for us, that business model, just that network economics profile, is more of an opportunity to problem solve, if you will, like what's the right investment structure here, as opposed to saying, no, this is out of the money, pass, let's move to the next one. So I think it's very much an opportunity to roll up the sleeves there. So that's a lot of what the planning grant covers. Through that work, that then would go to the investment team. And we think about our investments in, I'd say, three major categories. We first started this by thinking about project financing, really like a network with a certain set of economics with, within a confined or defined geographic area. Fairly high risk project financings typically are. And so increasingly what we were seeing, and that's the first vertical, increasingly what we were seeing was we were talking to the same operator doing like multiple projects. And it's like, well, rather than do a pretty heavy lift on 5 different projects, what if we did the investment at the enterprise level for the operator, and then they can spread that out across their portfolio. And so that became our second vertical, enterprise financing. And so that's more recognizable instruments, I think, to institutional investors, things like senior term loans, working capital lines of credit. But I think because digital equity is our spin to it, that's our North Star. We didn't just want to provide a traditional type of vehicle without some level of assurance that it was going to advance digital equity. And so what we bake into those investments are, instead of financial covenants like interest coverage ratios, et cetera, we think about it from a digital equity covenant perspective, right? So what % of your subscribers are low income? What is your low cost package as indexed to the area's median household income, right? Different metrics to try to make sure the money is going towards un- and underserved communities. And then the third vertical is innovative finance. And so this is one where we're really actively trying to problem solve, creating new different types of structures. And this is where being a digital equity investor, rather than just being, a fiber to the home investor, really gives us more scope to be creative and solve some of the underlying barriers. So an example there is device access. There have been a couple instances where communities have had all the investment they needed, whether that was private or public funding, for the infrastructure. But we then asked the question, well, what else could be a barrier to meaningful connectivity? And device access came up. So we're structuring a couple of vehicles right now where we say, what if we gave money to the operator upfront to buy all low-income households free devices? So from the household perspective, that barrier is removed. The operator then pays us back a portion of the monthly fee from the subscriber, only as long as that household is on the network. They go to a competitor, if they stop paying their monthly for any other reason, like moving out of the area, the operator is not on the hook to us for the remaining balance, right? And so the conversation then becomes us and the operator. To what extent does this lower your cost of customer acquisition? To what extent does this increase revenues from an addressable market that otherwise would not have joined the network? Right? And that's risk we're willing to take in the name of digital equity.
Right.
And so that's where we can get really creative.
we got a lot of good questions digging into some of the details of this, and I do want to get to them, but let me step back and make sure I'm understanding the breakdowns here. That you talked about these three verticals of project financing, and then enterprise financing, and then innovative financing. But I was wondering if you could speak to philanthropy versus I guess it's structured credit versus equity fund. Those are those products. Talk about those three things, Brian.
Yeah, those all flow through. So it's all just grouped into different types of grouping. So I would say the philanthropy one is primarily where a lot of the planning grants are coming out of. And then we recognize that, okay, well, after the plan, worst case scenario is the plan just sits on a shelf, right? Like I think that would be damaging for all. And so how can we create different types of capital tools to take the plan forward? And so that structured credit, that middle bucket really is to covers those three verticals I was just talking about: the project finance, the enterprise, and the innovative finance. And then I think where the concept of equity was coming from was, do we need an equity tool in some of these situations, in some of these communities, given that risk return profile, right? And so we don't have that capability yet, but I think in some early conversations, those have been some, I would say, themes we've been hearing. The way we've been solving for equity-like needs right now has been more in the project finance side. And so historically, project finance is some type of debt. But especially if it's from a commercial lender, but often projects require a mix of debt and equity, right? And so if a community isn't really in a position to take on debt, we weren't really comfortable providing direct equity, especially for infrastructure. Because we don't want to be in a position where we're owning community assets, right? We actually want to invert that, right? We want to enable community ownership of those assets. And so that's where we've been able to use kind of hybrid instruments, things like revenue-based financing that can take equity-like risk, but with kind of capped returns. So it's not excessive. Yeah.
No, I mean, and so this will be a digital equity fund, right?
Yeah.
No, that's super good. So let me get to some of these questions. So a question is your portfolio project-based financing only, or will you invest in operators? So I think you've answered that, right? Yes, you will.
It is a mix, absolutely, yeah. And so on the operator side, a lot of mission-aligned operators out there. I would say the spectrum that we've spoken to is, on the one end, fairly large regional operators that could have the whole suite of like design, build, operate capabilities. On the other end of the spectrum, talking to community networks, community-based networks that might be solving like a hyper local need, and everybody in between. So it's been really inspiring, I would say, just talking to all the different operators out there. And communities looking at it from a project perspective.
Right. And again, another question, are you debt only or will you do equity investments? You've addressed that. You will do equity, right?
And hybrids, right? And so I think kind of tying this back to your question around the matching, we really see ourselves as the 1 minus X for funding. Like, what is it that you need?
1 minus X, just define that for us.
Yeah, what's the remaining amount of capital and type of capital that you need? So if you have something that is 75% public funded and you need that 25% match, we can provide that 25% match. If that's too big, or you have, say, a commercial investor or a CDFI, community development finance institution, looking to plug that 25, but they might be a little skittish with the economics, we can provide a credit enhancement or some type of concessionary capital to incentivize them to come along, right? So we don't necessarily need to be the investor. We could also be a credit enhancement, like a guarantee or something, or concessionary capital, which would be more junior in the investment stack. So I think for us, we see capital as a problem-solving tool. So depending on the existing resources that you already have there, and investors lined up, the question then becomes like, what else do you need?
Yeah. Well, this refers to I saw you speak at one of our reporters saw and wrote a story about you speaking at a recent event in Washington, in which you talked about working with community development financial institutions, CDFIs, to bring about this holistic approach. Just again, it's always useful to start at the base level. What is a CDFI? Like, is that like a private bank that has some charter or mandate, or are they specialized financial institution? Tell us what a CDFI is, an example even, and how Connect Humanity has or will work with these types of institutions.
Yeah, CDFI, community-based investors would be the short of it. There's a lot of technical, like tax and legal implications were related to it, but I would say that at the heart is investments into local regional communities. And so I would say, and I think that event was with Rural LISC. Great event, and I think great thought leaders over there are really pushing to see how CDFIs can play a leadership role in where their capital can go. So LISC would be an example of a CDFI type of investor. And I would say with their capital, they can be also nonprofit. I think they can be very flexible with the roles that they play, and not necessarily kind of your bulge back bracket bank type of return expectations, but very much community partners in thinking about it holistically. So I think there's a huge role for CDFIs to play, but I wouldn't absolve other sources of capital, right? When we say spectrum, it's not just public, private, CDFI. I think there's roles for foundations with like tons of different types of capital tools beyond grant, right? They can provide guarantees, PRIs, MRIs. When I think about other philanthropic things like DAFs, donor advised funds, right? There's a role for them to play. Commercial institutions as well. I'd also put this back on private sector, because they have a lot of the mechanisms to channel a good amount of money fairly quickly. And so, is that their high net worth portfolio? Is that their own infrastructure fund? And so I think some of the things we're hoping to test in this is when we create a blended finance product, can we do it in a way where we can show how each of these sources of capital in their different positions, their own constraints and requirements and return expectations, can we point to different projects and say, hey, here's where you could play, right? And you could do more of this, right? And it fits your return expectations. CDFI, here's where you could play. But also, local credit union, this is where you could play.
Right.
Kind of translating what we see in an investment package or a network build package into language that they can understand and is recognizable to them.
Brian, when we had a chance to visit a little bit earlier before this call a few days back, we talked about kind of the role you can play. Maybe it's the Goldilocks role, right? I mean, foundations may do smaller grants, and big grants, big loans will come from others, but you kind of conserve somewhere in the middle. So could you speak to the minimum and maximum amount of funding you will do, and not just in a particular grant or loan, but also on a project by project basis?
Yeah, absolutely. So one element of our investment thesis was the size of capital for a lot of the operators that I think will be driving and crucial to driving digital equity. Just wasn't available, right? And so on the kind of six-figure side of it, philanthropy foundations really good at kind of the five figures up to maybe 250 to 500K type of thing. On the other end of the spectrum, we were
That's the philanthropy side, right?
yeah, right, like a grant at a time.
Got it.
On the other end of the spectrum, you had commercial investors, development finance institutions that were saying, really, we need 30, 50 mil plus to get out of bed. Um, but then when we spoke to operators, so much of the need was in between that, right? So much of the need was, I need more than a grant. I need that 500K or that mil, 2 mil, 5 mil, 10 mil. And I have nobody I can talk to. My local bank wants to securitize it against, my house. That makes me very nervous. And they don't really understand how, telecom or, network infrastructure. I can't go to private debt or private equity because I have limited track record. And so that's where we really started to see this opportunity really to say, well, what if we could provide capital in that range? And so I think that was from the capital side of it, and embedded in there was this idea that different types of capital may not recognize as much, like how do you network build? How can you say those network economics look good? And so I think when we were thinking about how to structure and staff Connect Humanity, we really saw that as multidimensional. So we have experts in finance, but not so deep on the technical. We have experts in technical. We have experts from philanthropy. And for us, the secret sauce really is that collaboration, right? Being able to speak across lines of careers and experiences.
We've got a great question from Mike Falloon here. He asks, often there is an inverse relationship between investment returns and community impact. How do you balance the two, Brian?
Yeah, that's a really good question. I think the part of our structure is helpful by being nonprofit, where we have stated that our objective isn't to maximize returns. And I think when part of our work in our community engagement with different communities is to let them know that there are investors out there that aren't necessarily trying to optimize on the financial return of it, and really looking to balance the two. I think the second thing I would say to that is a little bit of that. It goes back to the business model part, where I think if you copy and paste what has worked to date to connect, high income, middle income communities, if you copy and paste that paradigm of risk return onto low income communities, the math won't work, and we've seen that because they still remain largely unserved. And so I think it's an opportunity to rethink that business model. And I think that there's a whole broader conversation happening right now of, what is that role of capital markets generally, businesses in an ESG type of context.
Could you just define the ESG, the term there?
Environmental, social, and governmental returns. So really thinking more holistically about returns rather than just the financial dimension of it. And I think that's kind of the paradigm that we're challenging as well. And so I don't think for low income communities and rural communities that's been historically unserved, I don't think there necessarily needs to be a trade-off between financial return and social return. But if you put it in the context of, I'm private equity trying to 10x my money type of thing, then yeah, I think there needs to be some guardrails, and there would likely be trade-offs for that. But a fair return with positive social impact in connecting unserved communities, I we haven't yet really seen that trade-off.
Do you have a targeted investment return rate, Brian?
No, I think each community is going to be a little bit different, and that's where the blend really comes into play. And so, and kind of back to Mike's question, if a certain network economics, like if their cash flow profile really looks like it'll struggle, that's one where we may bring in more philanthropy or grants of some sort, whether that's from the state or the local community that's part of the build, to just try to right size the risk return there.
Who are the investors of Connect Humanity, and what is their mission and purpose?
Yeah, also been a range of, I would say, classic philanthropy, family, private foundations, all the way through to banks. So tons of sponsors. And I point folks to our website, because I would say incredible thought leaders in themselves. Our biggest supporter has been Truist Bank. And I think really hats off to them in seeing and trying to think about really advanced ways philanthropy and also banks can be supportive in this digital equity effort. And that's where, to this question of financial versus social and is there a trade-off, I think Truist is demonstrating putting their money where their mouth is, that it doesn't necessarily need to be.
Right. From a macro level, we're in this situation where interest rates are really rising because of inflation and other factors. We now have this, again, it's a great problem to have, is $65 billion in federal funds for broadband investment, but to some extent it's also kind of forcing a little bit of inflation in there too. I'm wondering what your kind of thought is on what's it like to be a banker right now, a financial institution right now in this broadband space, right? Is a financial institution basically going to say, I'm going to sit this one out because the government's already involved, or because entities like Connect Humanity? Or do you, by contrast, see there being great opportunities for more traditional financial solutions? Just talk a little bit more about the collaboration and what role you see that the private financial players playing.
Yeah. I mean, from an investor perspective, we would always need to manage our weighted average, rate of return with our weighted average cost of capital, right? And that gap or that spread, that's what implies financial sustainability and viability as an investor. I think that means there's, on the return side of it, let me start on the cost side. So on the cost side, we actively think about how do we manage that, right? And so are we bringing in, are we capitalizing ourselves with, kind of private debt on one end, but then, grants on the other, and how can that blend that cost down so we can manage, the cost side of it? And so I think there's a huge role philanthropy can play there. That really will also leverage a lot of their capital and kind of multiply, the money multiplier effect. On the return side, I think in any type of high inflation period or environments where institutional investors are seeking yield, if you will. I kind of go back to the fundamentals of what is it that we're actually building here, right? And at the end of the day, this is still infrastructure, right? And historically, infrastructure has demonstrated a certain consistency in economics, or at least the consistency of the level, right? Different networks might be higher economics, lower economics, but the consistency of it is still there. And so I think anybody thinking about a broader portfolio management where they have certain types of utilities in there for that yield, I think there's a role to play for digital infrastructure as well. When we think about digital infrastructure in low income or underserved communities, I think there's the stereotype that The consistency may not be there, or the return may not be there. And I think a lot of what we're trying to challenge is, fundamentally, I'm not sure if that's the right assumption about risk return profiles for and underserved communities. I think we need to think about differently about the business model, whether it's the owner operator side of it. But I don't know if it's fair to assume that low income communities are by nature, of lower return. So I think I'm excited to fast forward a few years and see some of the evidence and data from an evaluation perspective of these early investments.
So it's easy to think about the costs involved in the infrastructure piece, right? Because it is so expensive, can be so expensive to build it. What about these other aspects of the holistic equation that we spoke about? Are there a lot of costs associated with quote unquote affordability, with content, with devices? What are those the costs associated with things besides infrastructure, Brian?
Yeah. I think it'll depend on who is it, like what's the stakeholder you're trying to bring to the table. So I think the broad framework we like to think about that's driven a lot of kind of the creativity in different structures. It's been often I think you might hear the term investment stack or capital stack, right? Who's in the stack? We actually see 3 different stacks with every investment. Okay. And whereas the traditional, when you hear capital stack, that typically means sources of capital. What is the stack of investors? Whether that's Connect Humanity, grant, private investor, et cetera. The 2 other stacks I think are actually more important and a place to start. So the first stack is uses of funds, and it's what is the capital going to be used for? How much of it is for infrastructure? How much of it might need to be for digital literacy? How much of it might need to be for the local hospital system to set up a telehealth program, and similar thing with the local bank. And so for us, that the start is to ask about the uses of funds stack. The second stack is the repayment stack. And most traditionally, who's paying the investment back? And the biggest sources there have usually been user fees, right? Whether it's different subscriber anchors, residential anchors, or residential subscribers, or businesses, right? Business subscribers. When we say traditional business model, that's what we really mean, right? And so network economics, really just thinking about that as a way to pay off the uses of funds, the infrastructure. But when infrastructure goes in, that creates a lot of who else benefits from digital infrastructure and folks being online, right? And it's a lot more than just the actual user itself. What are the externalities that it creates for that area? It's economic development, it's workforce, it's education, it's healthcare, et cetera, right? Like the list goes on. And so it enables so much more. And so for the folks who might be enjoying some of those externalities, are there ways that we can tap into that, where we can formalize them paying a little bit their share of the network, if you will? So an example would be telehealth, where many studies have shown that telehealth demonstrably lowers operating costs, delivery costs for hospitals. And so through that savings, could you do almost like a cost share with that hospital, but outcomes based, right? If the hospital doesn't experience that savings, they don't need to pay in the network. But if they do, if they save $1, say per patient, could they contribute 20 cents, right? And then the hospital keeps the rest, right? And so could that help offset the economics to make the investment work? And it's after we really explore those 2 things, uses and potential repayment streams, that's when we ask our question of who needs to be in the sources of capital, and how much grant might we need to take off the top so that the rest can be investable. So that's I think
Yeah, that's great. That was extremely useful to think about, like this, the capital stack being uses of fund stack, repayment stack, but also sources of capital. And so speaking of the capital stack, right, do you prefer to be more senior as a secured creditor, or are you comfortable being unsecured? You kind of mentioned a little bit about this earlier on, but could you just come back to that now that we know a little bit more about what that means?
Yeah, 1 minus X. So if you have grant that can then make the rest investable, if you're able to fill that with, a commercial investor or CDFI or, your local credit union or the operator, right? The operator often puts a lot of investment into this. Then you don't need us. If the operator is a little skittish for, a small sliver of it, we can provide a credit enhancement, but the capital is already there. If that's unfilled and you've spoken to those folks and they're unwilling, right? We absolutely can step in and say, yeah, we'll provide the senior. Oh, you have a senior? We can provide the sub or the junior. Oh, you have that too? We can provide, the credit enhancement. I think where we get more, and throughout that journey, right, we can be that thought partner to think about who might you put in here, and how might our capital help you get them in. Or can we fill it all ourselves?
Yeah.
So that's not something we expect communities to solve all by themselves. Yeah, so it really is that thought partnership of what's the most optimal way to fill this. I remember what I was going to say. I think where we get skittish is when we fully grant for infrastructure builds. And our rationale there is we know there are going to be some communities and some builds where the network economics, it just requires it. To me as an impact investor, $1 for infrastructure I grant out, I know that's $1 of infrastructure money I can't give to the next community. And so my default will always be, is there some way we can create some type of recovery mechanism? Because if I give you $1, but things don't go to plan, but I'm able to get 50 cents back on that dollar, that's still 50 cents I can bring to the next community. And so for us, is that revolving idea of paying it forward, if you will.
Are there any particular areas of the country that you are focusing on, or is it equally everywhere?
Everywhere, where there's a need, I should say.
Do you do it outside of the United States or just in the United States?
Right now, we're primarily focused domestically. I think when we think about digital equity, it's a global problem. So I think we're actively talking about how we can help global communities as well.
Well, we've got about 7 minutes left, Brian, and I don't want to skimp on you and your background. And as a recovering investment banker, what attracted you to Connect Humanity? What's your journey in this space of finance and broadband?
Yeah, it's I wouldn't have connected these dots. Well, I'm only able to connect these dots looking backward, as the saying goes. So a child of immigrants. My parents came over during the Vietnam War, and the way they came over was more fortunate. So I think growing up, there's always this sense of service, community service, being service-minded. Started noticing I was getting interested in kind of economics-related questions. Why do people buy X versus Y? What makes a better investment versus not? And found myself at Wharton, and it was an interesting kind of reconciliation because kind of growing up with that service mind, service values of service, but then also finding myself in a little bit of the heart of capitalism. I started seeing or asking myself, like, what could happen if you got the public and social sector speaking the language of the private sector, especially around capital markets, and what could happen if you got the private sector speaking the language of public and social sector. And this was well before, I think, a lot of the language we have now around
Right.
impact.
That whole ESG language that you riffed on, and I wanted to get you to define, right?
So back then, my first stop was to really try to understand the capital market side of it. And so that was a bit more of a traditional investment banking, private equity experience. I'd say really colored by the financial crisis. So I was there before, during, and after the financial crisis, and saw, I would say, the potential power of financial engineering, but its inability to create sustainable value, especially by itself, right? It's just a tool. So who is using that tool? Why are they using that tool? And what are they using it for? And so that I think really impacted me early on. Then I spent some time with McKinsey. Joined them in their Singapore office before transferring to the DC office. And I wore two hats with them. One was strategy corporate finance practice, and the other was the public social sector practice. And increasingly, I was getting excited working at the intersection. So using corporate finance tools for public and social sector clients, and trying to get public and private capital to incentivize economic development, health outcomes, ed outcomes. So it's been that intersection I've tried to work at since. So I've spent some time with outcomes-based financing, social impact bonds. I spent some time in global development trying to kind of marry different capital structures with market-based mechanisms and principles with philanthropic programs. What could happen when you bring that lens to program design in the social sector? And I think what really drew me to Connect Humanity was two things. I think the first one was from an issue area perspective, and then I think the second was the blended finance. And so from an issue area perspective, I was doing a lot of work in health, financial inclusion, workforce, education, and underlying all of those promising solutions and approaches was connectivity, right? And so it wasn't too hard of a jump to say, well, if you care about any of these other outcomes, you have to care about connectivity, because without connectivity, you have no path forward for any of those things. So for me, that jump was very natural. And then on the second one, the blended finance part of it, I think it was that recognition that there are a lot of private sector investment financing structures, vehicles, well known. A lot of them have been copy and pasted for social sector purposes, social entrepreneurship, investing, et cetera. So a lot of those vehicles exist in a social and public context. What I think is the opportunity, and we're trying to think about it at Connect Humanity is what are those vehicles that you can't copy and paste from the private sector, right? What are those needs at the community level that need to be financed, and what are the structures and terms that make most sense for them, rather than me kind of begging, borrowing, stealing, the private sector tools? Do we actually need to create another set of tools that are more oriented around the communities we're trying to serve? So I think it was that opportunity to really just brainstorm
Right.
new ways to finance.
What impact do you think the Great Recession had on the evolution of finance? Again, with a particular reference to this blended finance world of connectivity that Connect Humanity is focused on.
Yeah. Oh, that's so existential, Drew. A few things. A positive thing is I think it got a lot of folks who weren't really thinking about capital markets to think about capital markets and how is it structured, what's it doing for me, type of thing, and how can it be used for things that I care about. And so from that perspective, I think it was really helpful in almost mainstreaming in a way conversations around it. and challenging, what should be the financial versus social trade-off. I think the flip side of that coin is it's a very nuanced conversation, but it's so easy to polarize it, right? You're either on the public social sector side where it's for the good, greater good, or your commercial investor, return maximizing. And so I think most of the conversation, most of the work has been in the nuances in that gray area in between, where it really is a balance. So I think a little bit of that flip side is, especially engaging a lot with community-based organizations and nonprofits, CSOs. There is some of that legacy feeling of, are you them or are you not? And we're neither, if you will.
Right. Well, that will have to be our last word. Before we thank our guest, we want to remind everyone that next Tuesday at 10:30 Eastern Time or 8:30 Mountain Time, NTIA Chief Alan Davidson will be at Mountain Connect. I'll have the great opportunity to be there with him and have a Q&A much like this one. And the next Ask Me Anything in our series will be on June 3rd with Elliot Noss, the CEO of Ting Internet. Very excited for him to be here with us, just as we have been so excited to have you, Brian Vo. Thank you for being here. And on behalf of the Broadband.Money community, have a great weekend, and we'll see you next week. All right.
Thank you for having me.